Arons is with us, founder, partner, Synergy Advisory Management Group, to take a look here at the importance of diversification. You can't just have all your eggs in one basket, right? Tell me more, Andrew.
Absolutely. You can't have all your eggs in one basket. You definitely need to diversify your portfolio. I mean, the market's been on a great run, and I know a lot of people are heavily overweighted into growth stocks, but over the long term, you definitely want to make sure that your portfolio is diversified so you can reduce the risk in your portfolio.
So tell me more about trying to reduce the risk in my portfolio. I mean, as we said, you shouldn't have everything in one place. I mean, how do you do this? Before I even get to bonds, I think we should have at least some. How do you divvy it up even between sectors or between large and small caps or between international and right here at home?
Right. I mean, you have to look at your risk tolerance, and you have to look at, large cap, mid cap, small cap. Then you have to look at whether you want to be in growth or value. And, we recommend a mix for our clients. We think it's a good idea to have your money very well diversified. We want to, again, reduce the overall risk of the portfolio. Multiple investments definitely helps you do that. A lot of people have not had any international exposure in their portfolios because international hasn't done well for the past decade. But now, we're starting to see the international markets and the foreign markets do well. So you definitely, right now, with where the market's priced, in my opinion, you definitely want to have your money spread out, as diversified as possible. We are using some short-term bonds in portfolios because, the market could pull back at some point and we could redeploy some of that money.
Tell me more about the bonds that you just mentioned, because you said you should have some bonds in the portfolio. So what kind of bonds are you really thinking?
So we're thinking about short-term bonds, not long-term bonds, obviously, because we don't want to have the interest rate risk. But short-term bonds are a good place just to have some money hanging around. So if the markets do pull back, you can redeploy that money in other areas. I mean, let's not forget that the market, peak to trough, usually the market goes down about 14% off the high during the year. And, 31 out of the last 41 years, we've been positive on the year. Last year, we were down big and early in the year, and then we finished nicely. You want to make sure that, you're not in like all tech. So if the tech market gets hit, you really get hit hard. You want to make sure that your portfolio is just diversified in a lot of areas. And over time, you should do very well if you're diversified according to your risk tolerance in the markets.
And then with that, I mean, what are your market expectations overall? I know a portfolio should be set up so that if you sell off, you're sort of ready for that. No one's ever really ready for that, but I guess you could be at least partially hedged. What are your expectations for this year and further out?
Well, I've said before, and I'll say it again, I think the market will probably return us, hopefully in the S&P, somewhere between 10 and 15% this year. I'm more concerned about the back end of the year in the market. I'm concerned that when things get back to normal, we may see some sort of a sell-off, and we may look at, valuations more because some of these stocks have run quite a bit. But I do think that earnings are going to come out and they're going to be pretty good. And I think that the returns are going to be very good the first 2 quarters of this year.
How worried are you about any sort of double dip recession or international recession? I mean, some people are worried more about the UK and things that are going on over there because of COVID.
Yeah, I mean, I think things are going to improve pretty much everywhere with the COVID situation. People are getting vaccinated, and I think that the risk of COVID will go down, and I think things will get back to normal, at the back end of this year. Overseas, I think the markets will recover just as well as they've had here. They may even do actually a little bit better because, the recovery really hasn't been priced into the market overseas.
If someone's around 50 years old and they want to invest some money ahead of retirement, what would you tell them to do now?
Well, I would definitely make sure that they know that the markets are at all-time highs right now, and we would set up a risk tolerance that would be favorable for them moving forward. We may not be as aggressive as we would have been, say 2 or 3 years ago with where the market is trading right now. So I think you have to be cognizant of where the market's trading. With that said, obviously bonds are not returning anything, and people need to be aware and have money maybe in dividend stocks. Maybe some money should be spread across real estate. Maybe we should be exposing more into the foreign markets at this point. So I think that an overall asset allocation based on what their risk tolerance would be, and if we have any market pullbacks, maybe adding to some positions in some sectors would be a good idea. But I don't think it's a great idea to just go all in right now thinking that things are going to be great.